As a lender, we need Nina in our life. And so we just want to talk about the different things of credit and how it affects, and try to give you as much education as possible. And then both I and her are available at any time to answer questions and help you along your path. So thank you for joining me, Nina.
Thank you very much, Brett, for allowing me to be a part of this amazing, amazing journey as we go in to educate those who do not have the education as far as what it is that you do, being an amazing loan officer, and also help them level up on their credit.
That's awesome. Well, let's kind of get started, and let's just explain what credit is. How does the credit system even work?
Okay, good afternoon, everyone. Again, thank you all for your time. Credit is such no amazing things. It's just that when we're not informed on how credit actually works is when we actually get in trouble with credit. So I'm going to break down a few components for you today. And like Brett said, if you have any questions, you can reach us both. So we're going to talk about the 5 main points that actually makes up your credit report. So we have credit utilization. With credit utilization, it's actually how are you using your credit, which means if you have credit cards, when you have a credit card, you only want to use 30% of that credit card, nothing more than that, because that will allow the time for your credit to report to the credit bureau in a positive manner. Once you go over 31%, it looks negative. It shows them that you are not responsible with using your funds in which they have allotted to you. So the credit card is very important to always keep that under 30% at all times. So for example, if you have a credit card that has $1,000 on that credit card, you only want to use 30% of that credit card. We'll bring it down even smaller. If you have a card that's only have $200 limit, which you are building your credit from, you still only want to use 30% of that card. So cards like that, you can use them for gas only, and that will help you build your credit as well. So you only want to use $60 of that $200 card, and then that will give you the momentum to building your credit and build your credit in a positive way. So that's credit utilization, is how much that we're actually using our credit. The next component, so part number 2, is the payment history. So credit utilization is actually 30% of our score, as I said. Payment history is actually 35% of it. That means whether you're paying your bills on time, not when they're actually due per se or the day after, but it's good. You can always call your creditors and ask them, when is your date billing cycle actually over? The date billing cycle, once that ends, it is not the same date that your bill is due. So your billing cycle may be over on the 10th of the month, and they may ask you for your payment on the 15th of the month. So if you know your billing cycle date, that will help you tremendously with building your credit the proper way. So that's 35%. So if we just put how we use our cards and how we actually pay our cards, that's a total of 65%. So that is the bulk of your entire credit score as a whole. So now I want to go over to the length of our credit history. So even though we may have cards out there when we were 16, 18, things of that nature, we may have not did the right thing by them, you don't want to necessarily close those out, because that's the portion that's actually 15% of your entire credit. That's the length of credit. So you don't want to necessarily get rid of that history. No, it may not be the best history, but yet it's still history, and you want to have the positive history on your account. So it's how long they've been open that will give you that activity on your credit card. The credit card loves activity, so the number of it is very important for the number of years. The next one we're going to do, which is the 4th part of it, is the type of credit. Is X type of credit. So what type of credit that you may have? Student loans are great. They may not feel great, but they're great to have. A mortgage is great. A car loan is great as well. So those are 3 items that are extremely well for your credit, because if you can get a government loan, which a student loan is nothing but a government loan, and you're able to have good traction with that, meaning that you're able to actually pay that on time, then that says, hey, we trust them with anything at this point, because they can pay the government back, then they can pay American Express, they can pay Wells Fargo, they can pay these other entities back. So that's a great safety net to have. And that's only 10%. And the last 10% that makes up your entire FICO score or credit score is actually brand new credit. So if you don't have any credit at all, you need to establish a secure credit card. If you have extremely old credit and you need to get some new things, open up a new credit card also, because your score depends on that 10% of that new credit. So it lets someone know, yeah, they're not stagnant, they're not stuck, they can still continue to build credit, and we can actually continue to give them more funds for whatever that it may be. We can trust them with new money versus old money. So those are the 5 components that actually make up your entire credit score. Again, is credit utilization, is at 30%, your payment history, which is at 35%, your length of credit is at 15, the type of credit is at 10, and brand new credit is at 10 as well.